Have you ever agreed to buy something in the future at today's price? Maybe you pre-ordered a concert ticket or locked in a price for a vacation rental months in advance. That's a simple way to think about derivatives. A derivative is a financial contract whose value depends on something else, called the underlying asset. It could be stocks, bonds, commodities like oil or wheat, or even currencies. Why do people use derivatives? Mostly to manage risk. Imagine a farmer who grows wheat. The price of wheat can change a lot before harvest. If prices drop, the farmer loses money. But with a derivative contract, like a futures contract, the farmer can lock in today's price, no matter what happens later. Now, derivatives aren't just for farmers. Airlines use them to lock in fuel prices. Companies use them to manage currency fluctuations. Even banks use derivatives to protect themselves against interest rate changes. Well, next we'll break down the different types of derivatives, like futures, options, and swaps, and how they work in global markets. Let's dive into futures, one of the most common types of derivatives. A futures contract is an agreement to buy or sell an asset at a specific price on a set future date. It's like pre-ordering something, but you're locked into the price today. For example, imagine you own a bakery and need to buy wheat every month. If wheat prices rise, your costs go up. But with a futures contract, you can lock in today's price for the next 6 months, no matter how much wheat prices fluctuate. Futures aren't just for farmers or bakers. Oil companies, airlines, and even investors use them to manage price risks. In global markets, futures contracts are standardized and traded on exchanges, making them accessible and transparent. What about options? Unlike futures, options give you flexibility. An option is a contract that gives you the right, but not the obligation, to buy or sell an asset at a specific price before a set date. Think of it like booking a hotel with free cancellation. You have the option to stay, but you're not forced to if plans change. For example, if you think a stock's price will go up, you can buy a call option. If the price rises, you can buy the stock at the lower agreed price and profit. If it doesn't, you let the option expire and lose only the small fee you paid. Options are popular because they offer a way to manage risk while keeping flexibility in uncertain markets. Swaps are a bit more complex, but very important in financial markets. A swap is a contract where two parties agree to exchange cash flows based on different financial instruments. The most common type is an interest rate swap. Imagine you have a business loan with a variable interest rate. If rates go up, your payments increase. To avoid this, you can enter a swap with a bank to exchange your variable rate for a fixed one, giving you predictable payments. Swaps help companies and banks manage risks related to interest rates, currencies, or even commodity prices. Finally, let's look at forwards, which are similar to futures but more flexible. A forward contract is a customized agreement between two parties to buy or sell an asset at a specific price on a future date. Unlike futures, forwards aren't traded on exchanges, they're private and tailored to the needs of both parties. For example, a coffee importer might agree with a supplier to buy coffee beans at today's price, but for delivery in 6 months. This protects the importer from price increases, and the supplier gets a guaranteed sale. Because forwards are customized, they're often used in international trade and by businesses with unique needs. Credit derivatives, an important tool in global finance that helps manage credit risk. Imagine this: you own a small bakery, and you supply bread to a big restaurant chain. What happens if the restaurant can't pay you one day? You lose money, right? Now, imagine if you could buy a type of insurance that protects you if the restaurant fails to pay. That's the basic idea of a credit derivative. Credit derivatives are financial contracts that protect investors and banks from the risk that a borrower, like a company or even a government, might not repay their debt. The most common type is the credit default swap, or CDS. It works a bit like insurance. You pay a fee to a financial institution, and if the borrower defaults, they compensate you for your loss. Why is this important? Because it helps banks and investors reduce their risks and continue lending money, keeping the economy moving. We talked about credit derivatives as a way to manage credit risk. Now, let's focus on one of the most popular types, credit default swaps, or CDS. Imagine this scenario: a bank has lent $10 million to a company, but there's concern the company might default. To reduce this risk, the bank buys a CDS from another financial institution. Here's how it works. The bank pays a regular fee, just like an insurance premium. If the company defaults, the CDS provider steps in and reimburses the bank for its losses. For example, if the company fails to pay back the $10 million loan, the CDS provider pays the bank that amount, helping the bank avoid a significant financial hit. But CDS isn't just for protection. Some investors use it to speculate on a company's financial health, betting on whether it will default or not. So, CDS can be a powerful tool, but it also adds complexity and risk to the financial system. Now that we understand credit default swaps, let's talk about collateralized debt obligations, or CDOs. Imagine you have a mix of different loans. Some are mortgages, some are business loans. A CDO is a financial product that bundles these loans together and then divides them into different parts, called tranches. Each tranche has a different level of risk. The top tranche is considered the safest, and it gets paid first if the loans perform well. The lower tranches are riskier, and investors in these tranches get paid only after the higher ones. Why do investors like CDOs? They offer the potential for high returns, especially in the riskier tranches. However, during the 2008 financial crisis, CDOs became infamous because the underlying loans were bad, and investors suffered heavy losses. CDOs are complex, but they're used by banks and investors to manage and spread risk across different assets. It is time to talk about total return swaps, or TRS. A total return swap is a financial agreement where one party agrees to pay the total return of an asset, like a stock or bond, to another party. The total return includes both the income from the asset, like dividends or interest, and any capital gains or losses. For example, let's say an investor wants to gain exposure to a stock but doesn't want to actually own it. Through a TRS, they can receive the total return from that stock without the risk of owning it directly. Here's how it works. One party receives the total return of the asset. The other party pays a fixed or floating rate in exchange for that return. The investor in the TRS doesn't own the asset but benefits from its performance. If the stock price rises or pays dividends, they gain, but if the stock falls, they lose. TRS can be used by hedge funds or banks to speculate, hedge risk, or gain access to assets without owning them directly. Back a few videos, we already talked about equities, but next we'll talk about equity derivatives, financial contracts whose value is based on the performance of an underlying stock or stock index. Common examples include stock options and equity futures. In a stock option, an investor has the right, but not the obligation, to buy or sell a stock at a specific price before a certain date. This gives them flexibility. If the stock price moves in their favor, they can exercise the option and make a profit. If not, they let it expire and only lose the premium paid for the option. Equity futures, on the other hand, are agreements to buy or sell a stock at a future date for a set price. Unlike options, these contracts obligate the buyer or seller to complete the transaction. Equity derivatives are popular for hedging, as they allow investors to protect themselves against stock price movements without actually owning the stock. They also give investors a way to speculate on market movements. Now, let's explore stock index futures. A stock index future is a contract that allows investors to speculate on the future value of a stock market index, like the S&P 500 or the Dow Jones. For example, if you believe the S&P 500 will go up in the next few months, you can buy a stock index future. If the index rises as you predicted, you make a profit. If it falls, you face a loss. Unlike individual stock futures, stock index futures don't involve buying or selling specific stocks. They're based on the performance of an entire market index. This makes them an efficient way to gain exposure to the overall market, without having to buy individual stocks. These futures are used by traders to hedge or speculate on broader market movements. They're especially useful for large institutional investors looking to adjust their portfolio exposure quickly. Now, commodity derivatives, financial contracts that derive their value from physical commodities like oil, gold, or wheat. There are two main types: futures and options on commodities. In a commodity future, two parties agree to buy or sell a specific quantity of a commodity at a predetermined price on a future date. For example, an airline might use oil futures to lock in fuel prices, protecting itself from sudden price spikes. Commodity options, on the other hand, give the holder the right, but not the obligation, to buy or sell the commodity at a set price before the option expires. This flexibility allows companies to hedge against unfavorable price movements while retaining the potential to benefit if prices move in their favor. Commodity derivatives are widely used by industries to stabilize costs and by traders to speculate on price movements. We've reached the end of our journey through the world of derivatives. In this series, we explored the key types of derivatives: futures, options, forwards, and swaps, each with its unique role in managing risk and enhancing financial strategies. Our goal was to give you a foundational understanding of these complex instruments and how they connect to real-world scenarios. Of course, there's much more to explore, but now you have the basics to navigate this essential part of global markets.